Welcome to the deep dive. We're about to really get into some foundational wisdom about investing today.
Yeah, the material we're looking at is pretty special. It's based on these excerpts from a Vietnamese edition of a truly classic investment book.
Right, heavily influenced by Benjamin Graham. But what's fascinating is it's updated. It includes thoughts on market events right up to the early 2000s.
It's like getting Graham's timeless ideas, but, stress tested against things like the dot-com boom and bust. You get the core principles and the modern lessons.
Exactly. So our mission here is to basically be your guides through this. We want to pull out the most important insights, the key lessons, maybe even some surprising facts that are tucked away in these pages.
The idea is to give you a shortcut, really, a way to get informed on these lasting investment principles straight from a source that's seen it all, plus that recent context.
Okay, so here's how we'll tackle it. We'll start with Graham's big ideas, the real foundation, then look at market history, investor psychology, that's huge.
Then we'll get into the different types of investments, bonds, stocks, the options, and a big piece on how to actually analyze a company, look under the hood.
And finally, we'll touch on, well, your role as an investor and the role of professionals, too. Sound good?
Sounds like a plan. Let's jump in.
All right, so the absolute bedrock, Graham's core principles. First up, and this feels critical, is his distinction between investing and speculating. What's the deal there?
Well, this isn't just, semantics. It's fundamental to how you approach the market. Graham was very clear. He said a true investment operation needs three things.
Okay, what are they?
First, it has to be based on thorough analysis. You got to do the work, understand what you're buying.
Makes sense. Homework first.
Second, it has to promise safety of principal. Now, that doesn't mean zero risk ever, but a reasonable expectation you won't lose your shirt. Your initial capital should be reasonably secure from major loss.
Okay, analysis, safety, which third?
And third, it needs to offer a satisfactory return. Not necessarily shooting the lights out, but a decent return that fits your goals and compensates for the risk you are taking.
So thorough analysis, safety of principal, satisfactory return.
Right. And Graham's point was, if what you're doing doesn't meet all three of those, it's not investing. It's speculation. Simple as that.
And the source material, it gives some pretty brutal examples of speculation right away, doesn't it? That Savold tire story.
Oh, yeah, that's a classic. Back in 1919, associated with the auto boom, someone apparently made a 250% gain on the first day of trading.
Wow. That's the kind of story that sucks people in, right? Easy money.
Absolutely, it's the dream. But the source gives the punchline. 3 months later, October 1919, Savold Tire, exposed as a complete fraud, stock worthless.
So that 250% gain, poof, gone.
Gone. And anyone who piled in based on the hype without analysis, without thinking about safety, wiped out. That's pure speculation textbook, Graham.
And we saw that same kind of dynamic, maybe on an even bigger scale, decades later with the tech bubble in the late 90s, early 2000s, which this updated source covers in detail.
Exactly. People just got swept up. Buying companies based on this belief in, unstoppable internet growth, not based on careful analysis of this specific company's value or safety or, frankly, realistic potential.
It was more about the story than the numbers.
Totally. The source points to the trading frequency on NASDAQ then. Their slogan was, this stock market for the next 100 years. Long term, right?
Yeah, sounds stable.
But the reality, the source says many clients weren't holding stocks for more than 100 hours. That rapid churning, chasing momentum, listening to the buzz, that's speculation, not long-term investing in a business.
And the danger, whether it's Savold Tire or this tech crash, is pretty clear. Speculation might give you a huge win sometimes.
Yeah, the ones that make the headlines.
But way more often it leads to really big losses for most people involved. It's more like gambling than building wealth.
Well put. It's like playing roulette versus carefully building a portfolio based on facts and value.
Which brings us right to another really deep insight from Graham in the source. He said the investor's biggest problem, maybe even their worst enemy, is themselves.
Oosh. Yeah, that one hits home, doesn't it? It suggests the market itself isn't the main danger. It's us.
It's our own reactions, our own psychology.
Precisely. And the source uses the story of Sir Isaac Newton to illustrate this perfectly. I mean, think about it. One of the smartest people who ever lived, understood physics, gravity.
Literally define how the universe works mathematically.
Right. And yet he lost a fortune, like 20,000 pounds, which was massive then, maybe $3 million today in the South Sea bubble in 1720.
How did that happen? You'd think he'd be too smart for that.
Well, he actually got in early, made some money, and got out. He was smart. But then he watched the stock keep going up and up. saw his friends getting richer, felt that, fear of missing out.
FOMO. Even Newton wasn't immune.
Apparently not. He jumped back in, near the top, and then it all collapsed. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." He let the crowd's excitement override his own earlier, better judgment.
So the source is saying investment failure often isn't about lack of intelligence. It's about lack of emotional control.
Exactly. It's letting fear, greed, envy, or just the sheer excitement of the crowd push you around instead of sticking to your own reasoned analysis based on value.
Okay, so if we're our own worst enemy, how do we fight back? Did Graham offer any tools?
He absolutely did. And maybe the most brilliant, most useful one is his analogy of Mr. Market.
Ah, yes, Mr. Market. Such a great way to frame market fluctuations.
Isn't it? So imagine you own a piece of a private business, and you have this partner, Mr. Market. He's, let's say, a bit manic depressive.
Okay.
Every single day, he shows up at your door, and he offers to either buy your share of the business or sell you his share. Every day, a price quote.
But his quotes aren't always rational, right? That's the key.
Not at all. Some days, Mr. Market is bouncing off the walls, totally euphoric.
Right.
He thinks the business is going to conquer the world. On those days, he offers you a price for your share that's way, way higher than what the business is actually fundamentally worth.
Okay, overly optimistic.
Then other days, he's slumped over, deeply depressed, convinced everything's falling apart. On those days, he's desperate to sell his share, and he'll offer it to you at a price far below its true value, a real bargain basement price.
So he swings wildly between fear and greed.
Exactly. And the intelligent investor, according to Graham, recognizes Mr. Market for what he is, an often irrational, moody partner. You don't let his mood swings dictate your actions.
You don't sell just because he's panicking and offering a low price.
Right. Nor do you get caught up in his euphoria and blindly just because he's offering a crazy high price. Instead,
You use him.
you use him. He's there to serve you, not guide you. When he's depressed and offering to sell cheap, you think, maybe this is a good time to buy, based on my analysis of the business's real value.
And when he's euphoric and offering a sky-high price,
You think, maybe this is a good time to sell my share to him because this price is much higher than what I think it's worth. You stay independent, grounded in your own valuation, not his emotional roller coaster.
the source specifically mentions how this played out after the tech crash, right? Stocks got cheaper, but people didn't want them.
Prices were falling, Mr. Market was depressed, and so were most investors. They became less willing to buy, imitating Mr. Market's fear instead of thinking, hey, these businesses might actually be cheap now.
It's about separating the price quote from the underlying value.
That's the core of it, which leads us directly to maybe Graham's most famous concept of what the source calls the secret to sound investment in 2 words.
Margin of safety.
Margin of safety. This is it. This is the central idea, the thread connecting all sensible investing, according to Graham. It simply means buying a security for significantly less than what you estimate its intrinsic value to be.
To do your homework, figure out what you think a company is realistically worth, say $50 a share.
Right, conservatively estimated.
And then you only buy it if the market is offering it to you for maybe $30 or $35.
Exactly. That difference, that $15 or $20 gap in your example, that's your margin of safety.
And why is that gap so vital? What does it actually do?
It's your cushion. It's protection. Protection against maybe making a mistake in your own valuation. Nobody's perfect, right?
Sure.
Protection against Mr. Market just having a really bad day or week and prices falling for no good reason. And protection against unexpected bad news hitting the company or the economy down the road.
So even if things go a bit wrong, you're still okay.
That's the goal. If you bought that $50 company for $30 and maybe things aren't quite as good as you thought and its true value turns out to be only $40, well, you're still ahead. You paid $30, it's worth $40. But if you'd paid $45 for it, you'd be underwater.
The source really stresses this, saying it's the only way to have a reasonable shot at avoiding serious losses over time. Applies to everything, bonds, stocks.
Everything. It ensures that the odds are tilted in your favor, even if the future isn't exactly what you predicted. It builds in room for error.
And this ties back to that idea of the investor being their own worst enemy, managing that internal risk.
Absolutely. The source talks about questioning yourself. First, do you have certified, well-founded confidence in your analysis? Like, is your valuation really solid?
Okay, intellectual honesty.
And second, have you accurately anticipated regret? How are you really going to feel emotionally if this investment goes down 20% right after you buy it, even if you think it's cheap.
Knowing yourself.
The margin of safety helps with both. If your confidence wasn't quite as well-founded as you thought, the buffer protects your capital. And knowing you have that buffer can help you withstand the emotional pressure if the price drops temporarily, reducing the chance you'll panic and sell at the worst time. It gives you staying power.
Okay, so those are the bedrock principles. Let's shift now to what the source draws from market history, and especially investor psychology. First big lesson seems simple. Markets fluctuate. A lot.
Yeah, J.P. Morgan Sr.'s famous line, stocks will fluctuate. It seems obvious, but people constantly forget it. Volatility isn't the exception. It's the rule.
The source gives examples going way back, right? Even in bonds.
Definitely. It mentions the unprecedented increase in yields of high-grade bonds between the book's earlier editions and the 1970s updates. When yields go up, bond prices go down. So even safe bonds fluctuate in price.
And for stocks.
It highlights the big drop ending in May 1970, about 35% for leading stocks. That was the biggest fall in 30 years at that time. Felt like the end of the world then, but we've seen bigger swings since.
The source also talked about speculation around growth stocks, starting way back after WWII.
Right. Since 1949, periods of intense speculation kept cropping up, especially around companies seen as successful growers. Their prices would swing wildly, often disconnected from the actual business results. Think Chrysler, its stock price bounced around way more than its underlying earnings did over the years.
So for investors like us, what's the takeaway? Expect bumps.
Expect them. They're normal. Fluctuations are part of the deal. And here's the thing. They aren't just problems, they're opportunities.
How so?
Well, for the prepared investor, the one with discipline, some cash, and that margin of safety mindset downturns are chances to buy good companies cheap from a panicking Mr. Market. And euphoric run-ups are chances to sell things that have gotten way overvalued.
But if you're unprepared or you panic,
Then volatility just causes pain. You sell low, maybe buy high, and destroy your capital. It all comes back to your approach and emotional control.
okay, another huge lesson from the history, especially the tech bubble updates. The danger of just blindly chasing growth.
Oh, this is massive.
Yeah.
The source draws two really clear lessons here. First, just because a business or industry looks like it has amazing growth prospects doesn't automatically mean it's a good investment.
Wait, that sounds counterintuitive. Isn't growth what we want?
We want profitable growth, sure. But the prospect of growth alone isn't enough. Lesson 2 is related. Even the pros, the professional investors, don't have a reliable crystal ball to consistently pick the future winners and concentrate on them ahead of time.
So finding the next big thing is harder than it looks, even for experts.
Much harder. And focusing only on growth potential often means you ignore the price you're paying today. That's the trap.
Examples.
Loads. The source mentions the early computer industry. Huge growth, obviously. But outside of IBM, most investment professionals made in other computer companies back then didn't make money for investors. Or airlines in 1970, record passenger growth, but the industry lost $200 million for shareholders. Growth didn't equal profit.
And the dot-com era examples are even more stark.
Painfully so. Monument Internet Fund up 117% in 5 months in 1999. Managers talking like it would go on forever. Analysts saying media stocks aren't going to fall back. They're going to continue higher. Pure euphoria.
Based on narrative, not value.
Totally. Look at Inktomai. Traded over 231 early 2000. By late 2002, 25 cents. Lost $25 billion in market cap. And get this, in the 12 months before hitting 25 cents, it had actually made $113 million in profit.
So the business hadn't completely died.
No. Mr. Market's mood just swung from insane optimism to complete despair. The price followed his mood, not the underlying, albeit perhaps diminished, value.
Or VA Linux, losing money hand over fist, but getting pushed to crazy prices just on the Linux story.
Yeah, losing 70 cents for every dollar of revenue over years, $30 million total deficit, losing $10 million on $15 million revenue in the latest quarter reported, yet the stock price was astronomical for a time, pure hype.
MicroStrategy, too, looked like the next Microsoft, up 566% in '99, then crashed over 99% by 2002.
And even comparing fast growers, Expeditors International grew fast, 30% a year in the 90s. EMC grew even faster, 60% a year. But when the downturn hit, EMC, the faster grower that had been bid up even higher, got hit harder. The more you pay for growth, the further you can fall.
Why does this keep happening? Why do we fall for the growth story at any price?
Well, the source suggests it's because the market gets carried away, projecting amazing growth rates way out into the future without properly considering risk, competition, or just how hard it is to maintain that pace. It's optimism overriding experience, as Dr. Johnson said. We want to believe in quick riches, so we ignore the price tag today. History shows that's usually a bad bet.
This seems linked to another trap the source warns about: trying to time the market perfectly, getting in at the exact bottom, out at the exact top.
Yeah, the source is pretty skeptical about anyone consistently doing that, especially after big events like the 1929 crash or the tech bubble burst. Can you really build a reliable strategy around predicting those turning points precisely? Probably not.
It seems impossible.
It's incredibly difficult.
Oh,
And there's that paradox again. Market crashes when things get really cheap should be the best time to buy, based on value principles. Graham said those periods make stocks safer, in a way.
because the risk of further massive decline is lower and the potential upside is higher.
Right. But what happens? The source notes people become less eager to buy then. Fear takes over.
Because they're imitating Mr. Market's depression instead of thinking for themselves.
Exactly. It's that emotional discipline again. When prices are low, sentiment is terrible. The pain of recent losses or the fear of more losses is overwhelming. So people freeze, or worse, they sell near the bottom just to stop the pain. They miss the opportunity that the price decline created.
And there's actual psychological research behind this fear of loss, right?
Yeah.
Kahneman and Tversky.
Yes, the source cites their groundbreaking work on behavioral economics. They discovered something called loss aversion. Basically, the psychological pain of losing a certain amount of money, say $1,000, feels about twice as powerful as the pleasure you get from gaining the same $1,000.
Wow, losses hurt twice as much as gains feel good.
Roughly, yeah. And that asymmetry drives a lot of irrational behavior. That intense fear of loss makes people sell low just to avoid potentially losing more. It makes them hesitant to buy low because the fear of that purchase also going down outweighs the rational assessment of value. It's a huge bias that constantly trips investors up.
Okay, let's move on to exploring the different investment options the source discusses, keeping these principles and pitfalls in mind. It starts with bonds.
Right, and it links the choice back to the investor, defensive, or enterprising. Bonds are traditionally seen as the safer, more stable part of a portfolio. High-grade bonds used to be mainly for institutions, big conservative players.
But we saw they aren't risk-free. Interest rate risk is real.
Very real. The source admitted it maybe didn't emphasize this enough in earlier editions given what happened later. If interest rates in the market rise, the price of your existing bond with a lower fixed rate will fall. Table 8-to-1 showed bond yields fluctuating over decades. Those yield changes directly impact prices.
What kinds of bonds does it cover?
Well, there are U.S. savings bonds, like the old Series E. You couldn't trade them, and you lost interest if you cashed them early. Good for locking money away safely, not for trading.
Okay.
Then there are other regular U.S. government bonds, treasury bills, notes, bonds, wide range of maturities and rates. The source notes you can buy these direct from the Treasury online, saving fees.
What about corporate bonds?
Issued by companies, so they carry credit risk, the risk the company won't be able to pay you back. Ratings agencies like Moody's assess this risk. The source contrasts top-rated I bonds with lower-rated B bonds, often called junk bonds. The buy bonds offered a much higher yield, like 8.23% in the example.
But that's not free money.
No, that higher yield is compensation for taking on significantly more risk that the company might default.
And municipal bonds. Munis.
Right, issued by state and local governments. Their big feature is the interest is usually free from federal income tax, and maybe state tax too if you live in the state. The source compares tax-exempt housing bonds yielding 5.8% with taxable community bonds yielding 7.6% back in '71, both government-backed, but the tax treatment makes a difference.
So choosing depends on your tax situation.
Absolutely. If you're in a high tax bracket, that lower 5.8% tax-free yield might actually give you more after-tax income than the higher 7.6% taxable yield. You have to do the math for your situation.
A big change since Graham's original writing, the source notes, is bond funds.
Huge change. Big companies like Vanguard, Fidelity, Schwab now offer low-cost bond funds. This makes it easy for regular investors to get diversification across tons of different bonds with just a small investment. Trying to buy that many individual bonds yourself would be a nightmare.
The source also mentioned that by the early 2000s, low interest rates were pushing people to chase higher yields.
Yeah, people were getting frustrated with tiny returns on savings accounts and CDs, but the source warns against just abandoning that safety net entirely.
Cash is not trash.
Right. Even if it's not earning much, cash provides stability, liquidity, option value. It's essential for emergencies and short-term goals. Chasing yield by blindly taking on more risk, maybe buying junk bonds without understanding the danger that violates the safety principle and can really backfire.
Okay, shifting to stocks. Common stocks. The source seems to favor a controlled approach for the defensive investor, not trying to constantly beat the market.
Yeah, it discourages the idea of being a stock picker, trying to find the next big winner for most people. That links back to the dangers of chasing growth and the fact that even pros struggle with it. The focus for the defensive investor is more on getting reasonable results safely, maybe through diversification like an index fund.
But the enterprising investor might look closer.
Right. Someone willing to put in the time and effort might find specific opportunities, maybe undervalued stocks or even those special government bonds mentioned. But it requires serious work and skill, much more than the defensive approach.
What about things like collectibles, art, stamps, diamonds?
The source is really dismissive of these as investments in the Graham sense. It says the area is full of fakes, hard to value objectively, prices are volatile and subjective.
The example of the 1804 silver dollar that wasn't even minted in 1804.
Exactly. Paying $67,500 for that.
Yeah.
How is that an investment based on analysis and safety? It's pure speculation, driven by rarity, maybe passion, but not sound financial logic. The source basically says, stay away if you're looking for reliable investment results.
Okay. The updates also cover some alternative securities, like convertible bonds. What are those again?
Convertibles are a hybrid. They're bonds issued by a company, so they pay interest and have a face value. But they also give the holder the option to convert the bond into a fixed number of the company's common shares.
So kind of like a bond with stock upside potential.
That's the idea. You get some downside protection from the bond features, the interest payments, the principal value. But if the company's stock does really well, the bond's price can rise along with it because of that conversion feature.
How did they perform historically, according to the source?
Citing Ibbotson data from 57 to 2002, they returned about 8.3% annually. That was about 2 percentage points less than common stocks overall. But crucially, they did it with less volatility and smaller losses during downturns.
Interesting trade-off. Were they hard to buy?
Individually, yes. Trading small amounts was costly. And getting diversification meant needing a lot of money, maybe $100K plus. But like with regular bonds, the source notes that low-cost convertible bond funds became available from places like Fidelity and Vanguard, making them much more accessible.
What about warrants?
Warrants are basically long-term options issued by a company, giving the holder the right to buy stock at a set price. They can be valuable if the stock zooms up, but the source warns about dilution.
Dilution?
Yeah. If all those warrants get exercised, the company issues millions of new shares. That spreads the existing profits over more shares, potentially reducing the earnings per share for everyone else. The AOL Time Warner example showed warrants could potentially increase the share count by 15%. That's significant dilution.
The source also mentions covered calls selling options on stock you own.
Right. It's a strategy where you own, say, 100 shares of stock trading at $95. You then sell someone else the right, a call option, to buy those shares from you at $100 anytime before a certain date. For selling that right, you get paid a premium up front, maybe $10 per share.
So you get $1,000 cash right away.
Yep. That premium is yours to keep. It gives you income, and it provides a buffer. If the stock price falls, you're still $10 ahead compared to just holding the stock.
But what's the catch?
The catch is the upside. If the stock skyrockets to $110, the person who bought the call option will exercise it. You have to sell them your shares at the $100 strike price. You miss out on all the gain from $100 to $110.
Ah, so you trade potential upside for current income and some downside protection.
Exactly. Less risk, but capped profit. The source mentions you can find info online, but doesn't really push it as a core strategy for the average investor. It's more complex.
Lastly, dollar cost averaging. This sounds simpler.
Much simpler and very effective for many people. You just invest a fixed amount of money, say $200 into the same investment at regular intervals, like every month, no matter what the price is doing.
So you buy more shares when the price is low, fewer when it's high.
Automatically. The source says this worked very well in the generally rising market after 1949, mainly because it stops you from trying to time the market. You avoid dumping all your money in at a peak. You just systematically accumulate over time.
Seems great for people saving regularly.
Yeah, especially younger investors building wealth over decades. It takes the emotion out of the buying decision and enforces discipline. Fits the defensive approach well.
Okay, let's dig into company analysis. This feels like where the real work happens. Graham had 5 key factors.
He did. For common stocks, he looked at 1, the company's general long-term prospects. 2, the quality of its management. 3, its financial strength and capital structure, how much debt it has. 4, its dividend record, and 5, its current earnings yield, basically how much profit it makes relative to its price.
Still relevant today, but the source says apply them in the current market context.
Right. And a huge theme, especially with the early 2000s scandals fresh in mind, is you cannot just trust the reported numbers. You have to look beyond stated earnings and assets.
This is the whole earnings quality issue, accounting games.
Exactly. The source goes into detail here with examples that were huge news then. WorldCom, for instance. They took billions, $3.8 billion of regular operating costs, like renting phone lines, and booked them as capital investments.
Which makes profits look way higher than they really are. That's just fraud.
It was outright fraud. Or Global Crossing playing games with revenue recognition, booking long-term contract revenue up front while pushing the costs way out. Makes the present rosy, but it's not sustainable or real.
Even pension fund assumptions. How does that work?
Companies estimate how much their pension fund assets will earn. If they bump up that assumption, say, from 8.5% expected return to 9.5%, like SBC did, it reduces the amount they need to contribute, which flows through as higher reported profit today. It's an accounting boost, not necessarily a reflection of better business performance.
And pro forma earnings get special criticism.
Oh, yeah. The source basically calls them earnings, as if the bad stuff didn't happen. Companies exclude costs they call special or non-recurring, Graham Disciples would say. Ignore pro forma. Focus on JAPE earnings, the ones that include all the costs.
Tyco's complexity is another example.
Yeah, so many acquisitions, so many special charges. The source mentions it was almost impossible to figure out their true historical earnings, even after regulators looked into it. Or losing capitalizing software development costs that should have been expensed. Or financing customer purchases, which boosts sales but adds credit risk.
So if net income is unreliable, what should we use? Owner earnings.
That's one alternative the source discusses, popularized by investors like Chris Davis. It tries to estimate the cash flow a 100% owner could actually take out of the business each year without hurting its operations.
How do you calculate it?
Generally, you start with net income. You add back non-cash charges like depreciation and amortization. But then, crucially, you subtract the estimated amount of capital expenditures needed just to maintain the business, keep the factories running, replace old equipment, stay competitive.
Add back depreciation, subtract maintenance capex.
Right. It gets you closer to the real cash generation. Though the source notes, even this involves estimates, like figuring out maintenance capex versus growth capex, or dealing with tax complexities like at ALCOA. It's not perfectly simple.
Financial strength Graham factor number 3. Debt levels.
Key factor. Source suggests aiming for long-term debt below 50% of total capital as a rough guide. And check the details. Is it fixed-rate debt or a variable rate that can become more expensive if interest rates rise?
And the ratio of earnings to fixed charges.
Very important. Does the company earn enough profit to comfortably cover its interest payments and other fixed obligations? A low ratio is a danger sign. Amazon in 2002, mentioned in the source, wasn't even earning enough to cover its interest that's precarious.
What about intangible value? Brands, patents?
Graham acknowledged these can be valuable, even if not fully reflected on the balance sheet. Strong brands like Lady Pepperell or Janssen, or a dominant market position. The source contrasts Ball Corp, low multiple of tangible assets, lots of debt, with Stryker, high multiples but strong growth, maybe reflecting intangible strengths. Value can come from tangible assets or these less tangible factors, but you need to analyze which it is and if the price is justified.
And the source revisits growth, cautioning against assuming fast growth is sustainable.
Right. The fastest growers often burn out. Maintaining 15% plus growth year after year is incredibly hard. Maybe 6-7% after-tax growth is more realistic long-term for many established companies. Overpaying based on unrealistic, unsustainable growth projections is a classic mistake.
The source uses lots of tables comparing companies side by side.
Yeah, those comparisons are powerful. Putting two companies from the same industry next to each other, looking at their PE, P-book, debt, growth. It forces you to ask why the market values them differently.
Like Air Products versus Air Reduction in '69. Air Products looked better, but cost almost twice as much based on earnings. Was it worth it?
Or Block versus Bluebell. Block at 99 times earnings, Bluebell at 7 times. Bluebell was the far better investment, even though Block's crazy price went even crazier for a bit. Shows how detached from value the market can get.
Flavors, IFF versus Harvester too. One super expensive, one cheap, but maybe justifiably so because profits weren't great despite huge revenue.
Right, you need both reasonable valuation and decent profitability. Or McGraw-Edison versus McGraw-Hill, showing how market perception led to very different prices. And the more expensive one actually saw earnings fall later. Price matters hugely.
The source also pushes digging into history and public records. A&P over decades, Northern Pipeline finding hidden value.
Yes, using resources like the SEC's ADGR database to research past deals, understand subsidiaries, real analysis goes deep.
And finally, analysis means spotting red flags. What are the big ones?
Companies consistently losing more money than they make via Linux. Using super complex or opaque accounting, Tyco, Global Crossing. Relying on aggressive assumptions, like SBC's pension returns.
High debt is a clear one.
Definitely. Or management that seems dishonest or perpetually over-optimistic, always promising the moon while results lag. Howard shows check.
Yeah.
Compare what they said last year to what actually happened this year.
And those serial acquirers.
Big red flag. Companies growing rapidly just by buying other companies, often taking on huge debt to do it. The source compares them to serial killers because they so often end up collapsing under the weight of bad deals and excessive leverage, destroying value. Think LTV.
Okay, let's wrap up with the investor and the professionals. Can amateurs, individual investors, actually do well? Maybe even beat the pros?
Graham certainly thought so, especially if they have emotional discipline. Investors who don't panic sell good companies in downturns have an advantage over funds that might face redemptions.
And Peter Lynch's idea, the power of common knowledge.
Right? Lynch argued amateurs have an edge, professionals forget. You, in your daily life, might notice a great new product, a pack store, a fantastic service before Wall Street does. That real-world observation can be a powerful starting point for research.
Is there evidence pros underperform?
Yeah, the source cites studies showing that, on average, mutual funds lag the market indexes after you account for their fees and costs. It's a persistent finding.
Why do they struggle?
Several reasons mentioned or implied. Herd behavior, nobody wants to be too different and wrong. Short-term performance pressure. The sheer difficulty of managing huge sums, a billion-dollar fund, can't easily buy meaningful stakes in small, nimble companies. The Nimble Fund example illustrates this scale problem.
And fees? Fees eat into returns.
Absolutely. They have to beat the market plus their fees just to match a simple index fund. It's a high bar.
So the individual's edge is independence, patience.
Exactly. You can be patient, focus purely on long-term value, ignore the quarterly noise, invest in smaller companies if you want, and avoid the herd mentality. You don't answer to anyone but yourself.
What about getting help? Financial advisors. The source says it's still a mixed bag.
Yeah, you need to differentiate salespeople from true advisors. Credentials matter. The source mentions the CFA, Chartered Financial Analyst, as a rigorous standard, like a CPA for accountants.
And you can check them out.
Definitely. Advisors have to register with regulators. You can look up their Form ADV Part 2 online, www.advisorinfo.sex.gov, www.ir.com, to see their background, fees, conflicts of interest, disciplinary history. Do your homework on them.
What questions should you ask an advisor?
Good ones include, how long have you been doing this? What's your investment philosophy? Crucially, do you invest your own money this way? Can you explain things clearly? Are you financially successful? What returns do you target? Be wary of promises over 8–10%. Will I get clear reports? If they can't explain their approach simply, walk away.
Are there advisors who follow these value principles?
Yes. The source names legendary value investors like Walter Schloss, Bill Ruane, Tom Knapp, Ed Anderson, Stan Perlmutter, and of course, Warren Buffett.
Yeah.
Reading Buffett's Berkshire Hathaway annual letters is basically a free masterclass in value investing.
What about being an active shareholder? Can individuals make a difference?
The source is a bit skeptical about organizing shareholders effectively, saying it's rare.
Huh.
But it mentions possibilities. Vote against bad directors, like at Enron where they approve shady deals, attend annual meetings, maybe use online forums to connect with others. Graham's ideal was having truly independent expert directors protecting shareholder interests.
Finally, share buybacks. Companies buying their own stock, good or bad.
Theoretically, it reduces the share count, boosts EPS, and should lift the stock price. But the source is critical, because companies often do buybacks when their stock price is high, during bull markets. That's like buying why it doesn't create value. Buybacks only really help shareholders if the company buys its stock when it's undervalued, when it's cheap. Too often, it's done for cosmetic EPS reasons, not because it's a good use of shareholder cash based on value.
So wrapping this all up, it's really striking how relevant these Graham-based principles still felt in the early 2000s after all the market turmoil.
Absolutely. The core idea is investing versus speculating, margin of safety, Mr. Market, controlling your emotions. They just keep proving their worth, decade after decade.
Understanding that difference between investing analysis, safety, satisfactory return, and just chasing hype. Confronting our own psychology, using tools like Mr. Market and margin of safety to stay rational.
Learning from history that volatility is normal, chasing growth blindly is dangerous, market timing is a fool's errand, and biases like loss aversion constantly work against us if we let them.
And knowing how to approach different investments, how to really analyze a company beyond the surface numbers, looking at earnings quality, debt, spotting red flags.
And realizing that as an individual, you can succeed, often by leveraging your independence and patience, things that professionals might lack, while also knowing how to carefully vet help if you need it.
The fact these principles endured through booms, busts, tech revolutions, it says a lot. The human element, greed, fear, herd behavior seems constant. And the basic logic of value investing remains the antidote.
It really does. Despite all the noise and complexity, the fundamentals stay the same.
So the final thought for you, the listener. Given everything we've covered, where should your focus really be? Trying to predict the next hot stock or the market's next move? Or diligently applying these timeless principles of analysis, value, and emotional control day in and day out, regardless of Mr. Market's mood? Something to think about.
That's the core question, isn't it?
It is. That's all for this deep dive.